Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello, everybody. My name is Min. I'm your co-host with Heather, and you're here with Min, Heather, Danica, Debbie, and Matthew. And you're listening to the SDA Housing Podcast, a show that explains, highlights, guides, and brings awareness about all things SDA in this ever-changing NDIS world. Heather, welcome.
Thank you, Min. So here we are to break down in a much more detailed manner the outcomes of the SDA price review, which was released on the 16th of June. Please listen into our first podcast, which was a general first up indication of what we've garnered from this and the exciting opportunities. This podcast is more about breaking down the individual results, potentials, implications moving forward, opportunities, and who loses out, if anybody loses out in this new world of SDA pricing. So initially I'll hand over to Debbie, who is our subject matter expert and lover of all things NDIS.
Thanks, Heather. Yeah, so we've had a few days to reflect the information in this report. There was a 64-page report that's just an overview of everything with the new prices and recommendations. There was also another 101-page report that was a little bit more detailed, that went into detail on all of the consultations from the different stakeholders and organisations that did put in their submissions to the NDIA for the price review. But in this small report, I think what's really interesting is the recommendations that they've listed in there. They've got 4 pages of recommendations outlining the actual recommended new SDA amounts, whether they are for builds that first enrolled on or after the 1st of July 2023 or previous to that date. Also for legacy and existing stock, there's some changes there. They also talk about changes to other things such as the initial vacancies, the SDA design standards where they talk about the whole fire sprinkler, National Construction Code subjects, the appropriateness of group homes. Also, things like supporting innovation, encouraging self-provision, talk about the tax incentives, and also things like market stewardship, where they talk about other recommendations such as a census of SDA dwellings, better information for the market, those sorts of things. So I think that's a really good, interesting 4 pages of recommendations to read in conjunction with the overall report.
Thank you, Debbie. That's a really good and interesting breakdown. And I think really if we had the time, we could break down each of those categories into a podcast. So this morning, our intention is to really delve into the potential that we see here. Danica, have you got any further comments about particularly building standards? Just throwing you under a bus again. Danica is our design expert.
So the NDIA and the Department of Social Services, they should be working with the Australian Building Codes Board and other relevant government industry stakeholders so they're going to provide greater clarity to the sector as to whether the National Construction Code prevents SDA dwellings from being classified as Class 1 buildings. And they're going to develop a long-term approach to the classification of SDA dwellings in the NCC that protects the human rights of people with disability to housing choice, appropriately protects the SDA resident participant against fire risks, and provides for a more ordinary home-like environment than that required under Class 3 in the NCC.
There's some wonderful initiatives right there. And thank you so much for doing that at very, very short notice and without a lot of warning. So thank you, Danica. Matt, have you any thoughts about the location factor?
Yeah, so I've just having like a precursory look at different elements of like the location factor. It seems to be that they're kind of, and it's a bit of a, I don't know, bit of a mixed message, but it seems to be that there's a stronger push towards the location factor on group homes and larger establishments. There appears to be, across the board, it's fairly equal, but there does seem to be some push towards group homes, if not a little bit.
Matt, how are you deciphering that push towards group? I don't understand.
So there's a different location factor for different types of properties in the same location. So I feel like there's been a bit of a mixed message, because early on, 6 months to a year ago, they were kind of pushing away from group homes just because it has implications for whether the participants living in the house have that same level of choice and control as they would with, say, a 3-bedroom house. But here, particularly I can understand it, particularly in areas, isolated areas such as Northern Territory, there does seem to be a stronger push towards group homes. And
I think if you read those columns there showing the location factor, I would have read it differently. I'm not saying you're right or wrong. I'm just saying, well, there could be a slight little increase in number on location factor for the group houses. It doesn't necessarily mean it's a push towards it. It just means that if you are going to build it, there's a slight little additional revenue uplift there just to cover.
Yep.
And I'm just going to jump in and say I believe that extra increase is to compensate for the cost of the extra land required for a larger dwelling, which is also talked about in other parts of the report. And just on that group home thing, there's actually, when I talked about the recommendations earlier, there is the recommendation which I have found very, very interesting. I don't know if you guys all picked this up. Recommendation 10, ongoing appropriateness of group homes. The NDIA should examine, in consultation with participants and providers, the costs and benefits to participants and to scheme sustainability of amending the SDA pricing arrangements to phase out the ability of new 4 or 5 bedroom group homes to be enrolled as SDA dwellings.
That's a bit interesting, yeah.
So there, yeah. So yeah, I think that's if there is an increase or a higher location factor, it's probably more just to compensate for the extra size of the block.
Yep. And not an additional increase based on group homes alone.
Yeah, exactly.
Thank you, Debbie. That's a really good pickup as well.
Can I please make a comment on this whole group home costing topic? Not that I want to talk about it. I don't want to talk about group homes, but on page 42 of this document is called the pricing model assumptions regarding ownership costs per dwelling. This relates to group homes too. So for a house 2-bedder for 2 residents, the cost for maintenance and outgoing is 29 grand plus property management, including management costs, is 13,000. So 42 grand a year for costs for a two resident house. For a 3-resident house, it's 32,000, 17,000, 49,000 per year for maintenance and outgoings and property management costs. For a group home, 4-bedder with 4 resident group home, it is 63,000 a year. And for a 5-tenant SDA group home, it is 58,000 per year. Okay. So obviously they're aware of more costs to run a larger house, a larger block. So they're giving a little bit of extra location factor for compensation. Now, speaking of location factor, I was looking at it very closely on the weekend, yesterday specifically, and I'm looking at, if you look at it closely, they've played around with the location factors here, right? I mean, I'm looking at apartments too, by the way. So I'm not looking at houses, but Logan in Brisbane, 1.08 for an apartment in Logan, whereas you would have seen it as a house last year, Matt, at about 0.8.
Yeah, it seems to, I feel like, I mean, I haven't done a direct comparison yet, but it feels like there's less, 0.8s.
Yeah.
Which you saw a lot in Queensland last year.
Yeah. Let me read out the numbers in just this little list here. Apartments, Parramatta, 1.01. Brisbane City, 1.00. Gold Coast, 0.97. Ipswich, 0.96. Logan, 1.08. Toowoomba, 0.98. Townsville, 1.18. Wide Bay, which is Harvey Bay and surrounds, 1.01. Adelaide West, 1.09. And Cannington in Perth, 1.20. Now, they are apartment location factors. Matt, do you have some of the housing location factors in front of you at all, or anything? Just some random numbers you might have in front of you, just to show our listeners a bit of an indication as to what the housing location factor differences are.
So for the 2-bedroom house or 3-bedroom for 2 participants, so in the Brisbane areas, you've got kind of Brisbane North, 0.98, Brisbane South 1. Gold Coast is 0.91, and then you've got Ipswich at 0.85. Sunshine Coast 0.87, and you've got Townsville. I was surprised by that. Townsville is 1.0. So
I can give you an answer as to why Townsville is a bit higher.
Yep.
Because they've actually taken into account the fact that it's at a high risk of cyclones. So
Makes sense.
Yeah. So you see what I mean? They've taken into account a lot more factors here when looking at the location factors and the pricing.
I feel like they've also taken into account, I mean, you're looking at Sydney, and for a lot of people, it's not viable in a lot of cases to build in Sydney because you've got that larger land price, and as a comparison to the regular rental market, it's not as lucrative, I suppose. And I feel like they've taken that into account to some extent. I mean, you've got some pretty big numbers in Sydney area. Northern Beaches, 1.29. Inner West, 1.44. Eastern Suburbs, 1.85. So these are huge numbers.
If you want big numbers in Sydney, inner Sydney is 1.9 for a house.
Yeah, that's
so let's break it down for a second here. If you own an old house in Sydney City region, I'm assuming it's a 3 kilometre radius of the CBD. I'm assuming, right? You have an old house, you knock it down, you build a brand new HPS fire sprinkler house for 2 tenants, and the income is going to be 90, 100-ish per person. With the fire sprinklers, an extra 5, 10, 7 grand, so 200 grand-ish, times 1.9 is now 380 grand a year income. Like they've really played with the location factors to not manipulate.
Compensate.
Compensate and nudge along investors in certain areas.
Can I just bring that back to the cost of land? And on pages 18, 19, 20, they talk about the cost of land per square metre across Australia in each of the SA4 regions. Okay, let's compare Sydney, City and Inner South. You're looking at almost $4,600 per square metre. Compare that to Brisbane Inner City, $900 per square metre. So obviously that's had a major effect with the location factors there.
So Debbie, across the board, do you think this will we'll be able to broaden the areas that we've been targeting? So currently targeting Melbourne, Brisbane, not so much Sydney. Does it open up the market with this new way of pricing?
Oh, I think totally, yeah. Matt, do you want to?
Yeah, I was just going to say, I mean, we've been kind of talking about Perth and Adelaide being new opportunities and having some level of first mover advantage. And you look at Perth and Adelaide and the location factors there are all above 1. Perth, you're looking at 1.10, 1.04. Adelaide is, you got 1.06 in Adelaide South, 1.11 in North. Both the outback in South Australia and Western Australia, 1.40. So these are, I mean, it's not as strong as you'd see in Sydney, but these are all, I suppose, incentives to push people into these new markets, I guess, which is pretty good.
I was doing some calculations yesterday with Angit Singh from Starter Constructions, who will do a few more podcasts this week on to be more technical on the design guideline and the SDA price review. And I want to give the people listening to our podcast the numbers here. 3 bedroom, 3 bathroom, 1 car design, HPS. Small lot, 375, 400 square meters of a block of land, and a small house, 200 square meters for a house, right? If you get 2 IL participants in this fire sprinkled house, the income is 180 grand a year gross income. That's double from last year. So you're going to ask me a question, well, what about FA, fully accessible? Well, it's 190. And what about HPS? 210. So the answer is a combination of between 180 to 210 is the answer for 2 tenants in this house. Because in this HPS house, it's either going to be a HPS or an FA or an IL participant. So I would dare say if the worst case is 180 gross income, minus those costs, and those costs were, what do we say? It was $42,000 a year. So 182 minus 42 is 140 net of costs, right?
Of income.
Of income, yeah. Yeah. And that was based off a location factor of 1.07. So location factor 1.07, fire sprinkler in there, which is an extra $5 grand per person, right? And IL. I think it's what this does is it makes you think, well, hang on, let me rephrase it. In the past, the investors were thinking, no, I want HPS built and I want HPS in tenants. That's all I want. Don't give me anything about that, is what the investor would be thinking, right? But now you're going, well, hang on. It's cheaper to build IL. But even if I did build HPS, I should embrace the IL participant because they are the majority of the marketplace out there. Because we all know how hard it is to find 3 HPSs in one house. We all know that. That's just common knowledge. But now if the income is almost the same as an IL and FA, IL and FA is pretty much the same, and they are almost slightly under HPS, why say no to an IL now? You wouldn't say no. So there's been a catch up there of that regard there. And then I looked at our Armidale, Queen's Park, kind of Southeast Perth kind of topic again. And there's been a re-weighting as well, guys. So for a one tenant in an apartment, IL is 90 grand ish. FA is 93 grand, I think. And HPS is 105. It's almost the same now. Why would you say no? You wouldn't say no anymore.
So this is a big win, not only for the investors, but it's also a big win for the participants because all these IL participants who've been knocked back are going to be able to move into a home now.
And they're going to have a lot of different options.
Going to have so many options.
Because Heather, again, back to the herd mentality, which we mentioned last episode, if everyone is holding out for the HPS participant because they have a built HPS house because they are after the high income bracket, high income outcome here, the reason why the stats, and Debbie mentioned the stats a few podcasts ago with Josh, 21,000 SDA funded participants right now in the marketplace, but only 7,000 or 6,000 of them are actually living in new builds, which means there's a gap of 14,000 sitting there somewhere floating in limbo, not going anywhere. And look, I don't want to put fingers pointing blame here, but some investors don't want the IL participants.
So, I mean, it's a time to be agile. It's a time to stop following the herd over the cliff and to think about better ways of investing. So, again, so much more to unpack.
Because there is a lot of houses out there that are empty. There are houses and apartments that are empty out there. And they're empty for many reasons, but one of the biggest reasons is they're not wanted.
I mean, this isn't to say that you can't, it's still good to build HPS because it does actually maximize the types of tenants you can have in the house though. But it does create great opportunities for everyone who can't afford to go that high spec.
For sure.
Debbie, you and I spoke on the weekend about how IL participants have degenerative
diseases, yeah.
Conditions.
Mm-hmm. Well, a lot of SDA funded participants.
Like MS. MS is one example whereby you might have MS one day and then 5 years later you're in a wheelchair, right? So doing the HPS is still okay.
Yeah.
If you can afford it.
Yeah. And that participant who's got IL funding, in 5 years' time, they might be in a wheelchair and they don't need to move because they're in a house that's high physical support.
Future-proof.
So they're future-proofed, yeah. So, yeah, HPS is still good, still a good option.
So the winner in this scenario is those IL participants who had nowhere to go and were not accepted into a HPS house are now embraced and cared for, looked after, and they have a long-term stay because they will be, I don't know, sadly to say, degenerative in the condition, but they can... And also the income being so close to HPS that the landlord will be okay. No worries.
Can I go back to, I like the location subject here in terms of, and this is also touching on some of what I was reading in the larger report from the consultations, is that there's been a real recognition that a lot of the houses so far constructed have been in greenfield areas in the new estates where they're not really needed or wanted. And obviously, as we've seen in these location factors and just the overall increases in prices, this is going to hopefully encourage more construction in infill areas, in the inner areas of the cities where the participants want to live, where they're going to be around their families, their supports. They won't be limited to moving out into the new estates that don't have the infrastructure necessarily that they want. But the fact was it was the only available property.
Any thoughts on the increase of Logan as a potential market?
Well, yeah, looking at the prices, as Min pointed out, the location factor there for units is much higher than it is for houses and villas, which is 9.94 and 0.98 So obviously they see that there is a lack of housing, of unit development in that area, and that's where they're happy to pay for it.
A lot of developers who've come across the last few months, they've been waiting for the new release because they're trying to offload their development sites. And I'm sure they are disappointed with the 20% drop in unit funding. In the past, the flaw with the developments for units was the HPS income was really high and the ILs were really low as an outcome. You remember our IMs, Matt, the tenancy mixes and the net incomes?
Yeah, in some cases you'd be looking at
4%,
at parity with the regular rental market.
Yeah.
Yeah.
5% versus the 12-13%. Now, with the reweighting of the IL and the HPS and FA funding, it's almost the same, whereby it's less risk because ILs can fit into the apartment market.
100%.
Yeah.
And just going back to kind of what Heather was asking before about Logan. You look at Logan and it's, what do we have here? It's 1.08.
That's apartments, right?
That's apartments.
The houses is how much?
0.98 and 0.94 for villas.
But that's the villas, but the house is different. How?
Not sure I have it in front of me. 0.94. Is that right? I think it's 0.94.
Yeah, houses are 0.94 and villas are 0.98.
Yeah, so with the I feel like that's because we were always saying that in Logan you have a situation where you're not going to get your HPS house, and there's too many places have been built. You're not going to get HPS participants in your house, but this is kind of a compensating factor as well. So you've got kind of an uplift on the location factor and your IL participant. That's all you need. So it does open up new areas of development and perhaps allows people to potentially build in a way which isn't that costly, as we mentioned, both on the land front and on the build front via the IL design.
Also in Logan, a lot of investment, state government investment in health. Logan Hospital is being expanded. Redlands Hospital is being expanded. Springfield Hospital has been expanded. There's a university in Springfield. So it's really, I always think of Logan as like a little triangle between the Gold Coast and Brisbane. So potential.
I think we haven't touched on robust much in this discussion today. I know we did touch on it in our introductory episode on the new price review, but just to review that. I think we might have been a bit negative, and it looks like the robusts have kind of missed out here, and they have. But I guess at the end of the day, if we're looking at anywhere between a 75 and an 86% increase in the robust funding for a house with two people, it still means that if you've got one person in that house, you're now getting an income that is feasible, and it does make it a
I was going to say that
realistic investment.
Min mentioned it earlier, just talking about how a lot of people might have a robust house and might shift to accepting IL participants in that robust house. And the flow-on effect of that will be that if you do choose to go the robust route and you do want to have robust participants in your house, it's going to be a lot easier to find participants, I feel like, just because people will be shifting to more of an IL focus. So it does, while there is obviously an effect of an increased price or an increased income on robust, there's also the flow-on effects of high demand for robust dwellings.
Yeah, I mean, the robust funding is still quite good. If we're looking at robust with a breakout room, house, 2 residents, but if you only get 1 resident in there, you're still looking at 100,000 gross income.
Yeah, I feel like it's a consistent 100,000. It's
Now,
more consistent.
Matt, last year in the old scheme calculator, you needed 2 participants to get 95,000 in Logan as robust. Now it's only 1, as you said, Debbie.
Yeah.
400,000.
Yeah, so it's still good for the robust. It's not as good as we would have liked.
It actually works out kind of well in that regard, though, because some of the robust participants can only live by themselves
That's
as well.
right.
So it sort of fits the bill in that sense.
Yeah, I mean, I would have liked to have seen that figure go higher, or for them to have introduced a single tenant house funding. And the single tenant villa funding, interestingly, has gone up 22% for robust, which is overall relatively low here. But, look, it's not all bad. They've got an increase across the board for all robust properties. It looks poorer when you're comparing it to the increases for fully accessible and improved livability.
Thank you, Debbie. Anybody would like to contribute last thoughts, concerns, opportunities?
Yeah,
Min?
I'm looking at this graph with Debbie on page 46 called the long-term supply and demand projections for SDA. And Debbie, it's really about the billions of dollars being spent on SDA funding, I believe.
Yeah.
Now, in financial year 23, it has it
About a less than 3.3 billion. So what's that? It's 300 something million. I think it's $350 million SDA spend.
or about 4,000 participants on new builds there. Because
Yep.
green is participants.
It's the new builds, yeah.
So they're saying they're projecting 25,000 participants.
Living in new builds by 2033, 10 years' time.
I think that's conservative.
Yeah. And a spend of about 1.6 billion in SDA funding. So obviously and that's in new builds. So obviously that's a big increase that they are projecting. But this, of course, highlights the fact that the NDIA perceive, and again, this is all written in this report when you read it front to back, that the fact is when people move into these new build SDAs, it reduces the expenses for provision of SIL, other supports, and it does save the NDIA money in the long term. So it looks like they're projecting they are going to be spending a lot more in SDA in the future, which we knew was going to have to happen for this to remain a sustainable scheme. And this has now been put in writing looking at that graph. That's how I see it.
And by the way, if you look at the government media reports the last 2-3 months, it says by 2032, which is 10 years from now, 2033, the NDIS will be $100 to $110 billion scheme. This SDA is only 1.8 billion of the 100 billion.
Yeah, it's a small amount.
It's a very small amount, yeah. So people who say, oh, the government's saying it's unsustainable and it may not, blah, blah, blah. Yeah, but they've just come out with another report here about the SDA.
Yeah, and here it actually says on the front page, the introduction in this report, SDA funding is provided to participants who require a specialist dwelling that reduces their need for person-to-person supports or that improves the efficiency of the delivery of the person-to-person supports that they receive. So there you go. It says in black and white, it reduces the need for support or the amount of support, i.e. reduces the amount of SIL funding and other funding that is paid as a compensation for the expenses in providing the SDA.
I think it's been a good follow-up podcast, Heather. We didn't get too technical, I hope, because we'll do a few more podcasts with Angad Singh this week about the technicality of the designs and the pricing. I think we've all contributed today, and yes, in the other podcast, our first impressions and a bit more detail today. Danica, Matt, do you have any final words of advice or wisdom from your perspective for any of our listeners listening to this show at the moment?
I would just say download this pricing change, take a look at it.
We'll have a link to the report in the episode.
Yeah. So just be aware of it, because a lot of people out there, if you're just, you're not doing, or you don't have updates or, regular kind of, I suppose, checking in on what's been happening in the NDIS, you might not be aware of it. So yeah, just, form your own judgments. We think it's overall a pretty good thing. It's going to be very good.
Yeah, honestly, it's a really positive outcome for everyone involved, participants, investors, everyone really. It increases the amount everyone's getting, and basically it's a no-brainer at this point. So
overall, exciting times. Watch this space as we unpack what the detail in the report, and we'll be hoping to share some more podcasts with you this week. And Debbie's got a couple of comments she'd like to share as well.
Oh, I'm just saying, look out for the podcasts between Min and Angad. I think that's going to be really interesting to go into more detail of the actual prices, particularly with respect to the fire sprinkler impact, the GST impact, and just what bottom lines we're going to see.
And by the way, just before we finish up here, you might wonder, why is there a GST input credit claim topic on this whole calculation? It's because a lot of buyers, they buy from their family trust, corporate trustee, or the superannuation fund, and they might claim the GST on the purchase price, right, for the individual house. If someone is a big investor buying a 10-pack of units from a developer, the developer will be selling it as plus GST, and the buyer who would have to pay GST on that. So it depends if they're claiming the GST as they're paying it and they're claiming it. So that impacts very slightly the actual rental income of the property. So that's the reason why it's applicable. Most investors will not be under it will be a GST paid and not claimed category in the thing. And Matt, Danica, I'm sure that we'll get a sophisticated calculator coming out in the coming few weeks.
I'm super excited for that, actually. Yep.
Heather, any final words?
All good. I think in exciting times for everybody in the NDIS space.
Agreed.
And that's 100% agreement.
We're going to see a lot more investors come back to the market because serviceability is now stronger with the income and the location factors are stronger and people are more comfortable. Yeah.
And also so pleasing to see that this is maturing, that they're understanding more about how to save money, how to make it more efficient. And so we're very happy to share that news with you.
Thank you very much, everyone.
Bye.
Thank
Thank
you.
you.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.